Hello everyone, welcome back, and today we're gonna do an AMD valuation. If you're new here, my name is Venus. I've been working in tech for the past 8 years and I have an MBA degree and I was focusing in finance. So I want to give you a perspective from someone who working in tech and also have an education background in finance. So without further ado, let's jump right into it. So here are the things we're going to be looking at for AMD. I do have a couple of different scenario and different evaluation model for us to look at AMD all together. So let's go over the DCF first. So I have made a few assumptions here. So for us to make DCF, and the basics are, number one, we need to go through the income and make some assumptions of its revenue and its future gross margin and its future growth of EBIT, and so that we can get to our earning before interest after tax. And then we'll calculate our cash flow items, which are the depreciation and amortization and capex and changing net working cash flow. So that will give us our discounted cash flow. And from there, we'll calculate our WACC, which is our weighted average cost of capital. And that will give us our present value to our free cash flow. And we'll also calculate the terminal value, and that will bring us to the present value of the enterprise value, and which we'll use that to calculate the implied share price. So that's the whole logic behind building a DCF model. And so let's go over the assumptions. So I pulled all the data all the way back from 1999 and last year, and we have the last year's actual data, and that's the base that we're going to be working with. So in terms of the revenue, and from the year 2022 through 2023, AMD actually having a decline, mostly in gaming and its client section, which are the majority of the PC of the world, and a lot of gaming also declining. So that was a major reason. And moving on to the year of 2024, the analyst consensus is around 25%. And you can look up the data in Yahoo Finance. So this is how I will be looking at this data. So I will go here from the analysis growth. Next year, projected 51%, and next 5 years, average growth is going to be 25% every single year. So that's what we used for the base case. So I used 51% and 25% for the remainder year and 20% for year 5. So that's our revenue assumption. And based on this growth, and we can populate the revenue number for each year. So that's a revenue. And in terms of gross profit, and we have the year 2023's gross profit number, which is around 45%. And the year after, the assumed number is 52%. Assume that AMD can continuously be a little bit more profitable, and there is more analyst consensus number, and you can pull from different website sources. And this is just the assumption. I think that makes sense to me. And when it comes to operating income, and this is where it gets a little bit tricky, because if you look at AMD's financial, its GAAP operating margin is only 2%. So this is based on the general accounting rule, and that will be 2%, which is pretty low. And if you dive deeper, so they also have their non-GAAP operating income, and that added back the stock-based compensation, amortization of acquisition-related intangibles. So this is something interesting that last year AMD has done 2 acquisition deal, and also the Excellent acquisition, which was done in 2022. So some majority of the amortization cost is coming from that. So from here, I would say I would add back the amortization of the acquisition related intangibles, with the caveat that you actually So you can look this up in their financial statements. And the key point here is to know that the amortization is never going to be just a 1 year or 2 years. It's going to be over the 10 years, next to 10 years down the road. And every year they will amortize a different amount. So I think it sort of makes sense to add it back, but also keeps that in your mind that in the year 2024 and 2025 and going forward, and you probably will still see around 2 billion-ish number for this amortization item. So with that being said, that I added that number back. So the amortization, I added that back. So our operating EBIT, I'm going to go with is the 3.2 billion number instead of the 400 million. So that gives us the operating income, the operating margin of 15%, which I think is pretty reasonable for this year. And next year is where it gets interesting. So I assumed this is going to be 25% of its revenue. The reason being that their new GPUs that's just launched against, so their new GPU, MI300X, that launched to compete with NVIDIA's H100, and that priced at $10,000 to $15,000. And even though it's still a lot cheaper than NVIDIA's, but if you look at NVIDIA's margin, I do believe that there's a lot of room for this new category. So I gave AMD a very high estimate in terms of its percentage of revenue for its operating margin. And next is tax. This is really simply straightforward. I'm just using the same number from the last year and assuming the same for the remainder of these year until 2035. So that's all our revenue related items, and from there you can get your earning before interest after tax, and you can calculate that number with these two items. So moving on to the cash flow items. So depreciation and amortization, I'm using around 3%. So I looked up AMD's history. It's around anywhere between 2.5% to 3%. So I'm using 3% for simplicity. And CapEx, so this is around 2% of its revenue for the next couple of years for any of these items, and you can feel free to adjust. And I'm just gonna go with this very simple assumption for me to go with, because I think the majority of the impact is still coming from the EBIT assumption we just made, and that's a huge item to impact the free cash flow. So changing net working cash flow, and you can find this from the cash flow statement. This line item, and I just took the exact number and plugged it in here, and from here you can calculate your unlevered free cash flow, and that's basically your earning before interest after tax plus back the depreciation and amortization and minus the capex and minus the changing net working capital. So that's that, and you will get your unlevered FCF for the remainder of the years, and then we'll need to calculate the present value of our FCF, and we'll have to calculate our WACC first, which is the weighted average cost of capital, and this is AMD's current market cap and risk-free rate, and that's what we use, the Treasury 10-year T-bill and beta, and you can easily find that information anywhere. And so just to quickly flash that number here, and as you can see, the beta 1.63, that's what we are using, and market risk premium 4.57, and you can find that on the internet. And debt, and this is the current debt that AMD has, and the percentage of that is just use this number divided by its total value. And cost of debt, I'm using a 3% as assumption, and which is pretty common for a company like AMD has a low cost of debt. and tax rate 13%, which was we just talked about, and we got to our WACC, which is 11.63%. So that's what we're gonna go with for calculating the discounted cash flow. And so that get us to our present value of our free cash flow. So now we have all the years present value of free cash flow worked out, and we'll need to calculate our terminal value. So basically means after the year of 2035 and how we see AMD continue to grow as a more established company. And from that, we typically assume a terminal growth rate at 3%, which is very typical for a company in the more mature and established state. And use that divided by the WACC minus the terminal growth rate. So that's how you get to your terminal value. And we'll have to discount the terminal value back to its present value, which we use the WACC to discount it back, and this is our present value of the terminal value. And for the enterprise value, which is we're using the present value of free cash flow, all the 12 years of them, and all add up together and add the present value of terminal value. So that's how you get to the enterprise value. And we'll need to calculate our equity value, which is using the enterprise value minus debt and plus the current cash and cash equivalents. So that's how we got to our equity value. And diluted share count, currently AMD have 1.6 billion. And so for us to calculate the implied share price, is basically using its equity value divided by the diluted share count. So that's how we got the implied share price. So just a quick recap for us to get to this $112 implied share price, and AMD has to maintain a 52% of the operating margin for the remainder of the years, and also 51% growth rate in terms of its revenue growth, and 25% for the remainder years, and etc. So this is a fairly aggressive assumption to make, I would say. And also we remember that we didn't use a GAAP operating income. We used the GAAP operating income, and plus back is amortization from its acquisition, which is a very generous assumption to make for AMD. So even with that, we can still see that currently AMD's price is still trading a lot higher. So it's about 36% over its implied share value, which is kind of high, I would say. And I made two other assumptions cases here. So one is basically assuming a more aggressive growth for AMD. If you watched my other video that we have done this for NVIDIA, and NVIDIA's growth rate is a lot more aggressive. So 3 years, 100% year over year, and 50% for the next 2 years. So if we use that assumption applies to AMD, the first year's growth rate as 100% and 50% for the next 2 years, and AMD's price will be over $200. So that's a very aggressive assumption to make. NVIDIA's earning and price is already fully reflecting that the growth from their A100, H100 cells, but AMD is kind of catching up in that space, and they just launched their rivalry to NVIDIA's GPU end of last year in December. So this number really, the revenue numbers, 22.7 billion we started off with, is really not accounting against any of the future GPU growth and sales that AMD might have with their new chip. So with that, I would say this is actually something that's possible, just assuming that AMD can continuously to grow. And I want to quickly also touch on AMD's product. So this was what they launched end of year last year. and they're already having a lot of orders. So this is some of their metrics against the comparison of NVIDIA's H100. I'm not an expert in the semiconductor sector, but just from a glance, and a lot of also testing was done, basically proved that AMD's GPU MI300X is nothing less than AMD's is nothing less than the H100, and some report even says here 1.3x in terms of its performance. But the key point here is AMD's GPU performance can be on par with H100. So basically that implies AMD will take a very good chunk of the market that NVIDIA currently is having. And also keep in mind that AMD's chip cost is about 1/3 of what NVIDIA is charging for. So AMD has been doing really well in terms of taking over market share from the leaders like Intel from the past, by making cheaper and more cost-efficient product. So I think this can very likely happen with AMD with its new chip and become a rivalry against NVIDIA and capture some of that market share and the growth that NVIDIA is currently having. So this 100%, 50% growth, I don't think is outrageous, but it is kind of a bet in the future because we haven't seen any of the solid revenue number here just yet. So I also made a low case for AMD. So this is basically assuming that AMD continue to grow at 20% growth rate, which is still pretty high, but kind of lower on the end in terms of the consensus estimate. So that's the DCF that we just made, and let's take a look at a few other valuation model. So from Graham's valuation model, the EPS for AMD is really low because, like we just talked about, because AMD's acquisition in the recent years from Xlink and a couple of other AI-central companies, that gave AMD a $2.8 million acquisition-related cost that amortized annually into its operating margin, and that have a pretty big impact to the EPS. And if we try to calculate this number differently using a non-GAAP EPS, okay, so the non-GAAP EPS, what we can get to is 2.65. We can use this number to 2.65 to run this model, and that will give 2.65. That will give NVIDIA's intrinsic value to over $200. That's a very high valuation. But again, this is adding back the amortization from the acquisition, and also this was adding back the stock compensation. So I should probably just mark here. This is non-GAAP EPS. Let's take a look at the multiples. So here I used the non-GAAP EPS again. And to compare that with some of the more traditional tech and some of the companies from the Magnificent Seven, if you will. So this is the average PE I'm using, and AMD's price will become $104, which is on the lower end. But if we use the semiconductor sector's average PE, NVIDIA's PE is at 66, which is very close to AMD's PE. And that will come to 192, which is pretty high. And but if we use other semiconductor chips, and these AMD's price will be very, very low. I will kind of ignore this section. So this is how we got our multiples. And now let's take a look at the summary. And right now it's definitely valued over than what the forecast is going to be for the next year and the year going forward. But if you're being extremely optimistic about AMD's new chip that's becoming a rivalry of NVIDIA and taking market share from NVIDIA and having more, which I think the high case is actually possible. If you watched NVIDIA's recent earnings call, that Jensen Huang is stating that the demand is definitely there for this market and it's definitely going to be continue to grow. And I think AMD's price advantage can definitely take a good chunk of the market share there. And because everyone is trying to optimize for costs and these chips are really expensive, and I think AMD do have a pretty strong edge there. But for the next year, if you are thinking that AMD is not going to be able to capitalize on this opportunity and maintain a relatively steady growth rate around 20%, AMD's stock worth is only going to be $80. And the other valuation we just look at based on Graham's valuation, but we're using the non-GAAP EPS earning, and that implied the share value is over $200. And if we compare against the other big tech and other semiconductors, and these are the relative earning. So just in conclusion, to wrap this up, I think right now AMD's price is already factored in the future for being able to capture the growth in AI, and 50% is kind of right in the middle if you think about it for the next year, and AMD's projected growth for the next year is 100%. So I think right now the 50% estimate is already fairly aggressive, and our share pricing right now it's already reflecting a very good chunk of that future forecast. So AMD has to be really on top of his game to be able to worthwhile of the current share price. So for me personally, I think everything is possible. Even the most optimistic case is possible for the future year. But as you can see, there's also a lot of downsides to this case. And if AMD just only maintain a 20% year-over-year growth, and that's about over 50% downside to the stock. So make your own assumptions and do your own research and before you make any purchase decision. And I do have a copy for these valuation models that I'm using, and check out the description box down below. And thank you so much for watching, and subscribe before you go. If you like content like this, give it a thumbs up so I know about it, and I'll make more of the valuation like this in the future. And thank you so much for watching, and I'll see you next time. Bye.